Welcome to It's the Economy. Last evening, the Reserve Bank announced it will pour in another tanker load of 1.25 trillion rupees of liquidity into the interbank market in May. The Reserve Bank is clearly way more interested in growth and much less worried about inflation. Of course, this was evident in the minutes of the Monetary Policy Committee meeting as well, when practically all members argued that inflation is well within the MPC's comfort zone, while growth is under pressure both domestically and due to the global tariff wars. Only one member, Saugata Bhattacharya, sounded a tad cautious in the minutes. Joining me now is this external member himself, Saugata Bhattacharya. Good morning, Saugata. Thank you very much indeed for sparing time for us. Well, I just wanted to start with your minutes. In the minutes, you seem to be not wanting to vote for the accommodative stance because you wanted the freedom to pause when needed. So you think a series of rate cuts are not in order?
So first of all, thank you so much, Latha. Great to be back on your show. Thank you very much for having me.
Thank you.
Yes, I mean, as you could tell, of course, I mean, there was no voting on the stance this time. It was just a unanimous decision. Going into the minutes meeting, I was a little cautious about switching from neutral to accommodative, because I mean the implication was that this indicated a pre-committed rate decision, a path of rate cuts, which I was a little cautious, because remember, I mean, given the uncertainty, the extreme uncertainty, which at that point in time was characterized by the global situation, the trade tariffs and other retaliatory measures, I felt it would have been good to retain the option. As you mentioned, I mean, there's very little chance of a possible need for a rate hike at this point in time. The balance of probability is clearly against such a move. But as you've seen with multiple central banks, they have indeed paused in their rate cut trajectory, rate cut, or in the Bank of Japan, a rate hike. So I mean, there is a possible need for a pause. During the deliberations, it was clarified that a shift to accommodative just took a rate hike off the table. There was, in that guidance, there was the possibility of a pause. So I'm fine with that. I just indicated that a potential for a pause might be a good option to optionality built into the policy at this point in time. It's as simple as that.
Okay, got that, and it's important for you to clarify. But just a clarification for me as well. Isn't the stance put to vote? I mean, was there a change this time? Did you all vote last time but didn't vote this time?
Yes, there was a change in the process. Remember, in the MPC Act, in the RBI Act, well, for the MPC, there is no mention of a vote for a stance. There is no mention of a stance. And there is that phrase that the chairman of the MPC, which is the governor, the RBI governor, has the right to put in. I'm just paraphrasing. I don't remember the exact wording of the act. That the chairman of the MPC has the right to pull in anything that he or she might deem important at that point in time. Also, remember, in terms of history, that the stance, voting on the stance, was only introduced in October of 2018, not before.
Oh, it was not introduced in October 2016.
I had forgotten that.
Okay.
So, yeah. So that
2018, you all voted, and you all voted till December of 2024. February. And in February of 24, till February of 24, you voted. But in April of 25, the stance was not put to vote.
Yes.
Okay. That's actually an important nugget. Not that it makes a material difference, but it's important to know that it was not voted in April itself. But Saugata, to come back to what you are seeing in terms of the inflation trajectory, if you look at 3.6, if you looked at the Jan, Feb, March, April numbers, we are running almost at 3.5% in terms of an average CPI. That would give a real rate even at the moment of almost over 2 percentage points. So would you say that 2 percentage point real rate is needed, and or would you say that it needs to fall?
I think the balance of probability, given what we expect of inflationary pressures going forward, given the fundamental drivers. Remember that at this point in time, forecasting is essentially just indicating the direction of travel. That's all. We really don't know how things will pan out tomorrow, 3 months down, when the 90-day period ends, what kind of trade deals come in, what supply chain responses, etc., are. We really don't know. So that just indicative of the direction of travel. So even if these tariffs remain in place in the event, there might be a short-term increase in inflationary pressures because of supply chain dislocations. This is exactly the same that happened during the COVID period, and then to a certain extent during the start of the Ukraine war. But there might be some short-term inflationary pressures. But over the medium term, the dynamics governing global growth, global trade, whatever is happening in China, etc. So oil is likely to remain fairly moderate. Commodity and metals prices are likely to remain moderate unless there is a major increase in Chinese growth impulses. So all of this, a normal forecast monsoon, etc. So, given all in totality, the balance of probabilities that inflation is likely to remain moderate, and hence, as you mentioned, at this point in time, the real interest rate is higher than what the last known analytics of the real interest rate. Which, if you remember, during last year, in January to March of 2024. The RBI analytical studies had indicated the real natural rate would be about 1.4 to 1.9%, right? So if you assume that inflation is likely to be at the target of 4%, then that would translate to and this is, remember, the 90-day Treasury bill, 3-month Treasury bill, so which is about, in a steady state, which is about 20 to 30 basis points above the repo rate. So there is space for rate cuts. There's absolutely. I'm not saying anything which is really startling or. Yes. So we are proceeding with caution. This is what is now being called in the markets as good news. The space for good news rate cuts. So I think that's exactly it.
However, I take your point. Yeah, go ahead.
Having said that, sorry. 5 more seconds. Having said that, the growth that we are now seeing does not really necessitate a rush into front-loading rate cuts. We are okay. A 6.2, 6.3% FY26 growth rate, even if it comes down to that, is fairly okay to my thinking, given whatever we are seeing in the global economy. So I think there's no need to rush into front-loading rate cuts, but a steady reduction of interest rates, I think, is needed at this point in time to support growth. And 5 more seconds, and you've done an extensive recount of the liquidity measures that are now being put in place. So I think even with these rate cuts, with a steady pace of rate cuts, I think actual transmission into lending rates and deposit rates will happen fairly quickly. So I think we are okay on that part.
Okay. Yeah, I'm glad you touched the liquidity part. I will come back to growth, time permitting. But liquidity, of course, is needed for rate transmission, as you pointed out. But as Samiran Chakrabarti pointed out in this morning's note, the amount of liquidity the Reserve Bank has given from January to today, or rather today, till by the time the May calendar ends, is 5.3 trillion. The only other time when it gave 5.3 trillion was during COVID, and that was over 6 quarters. Now they are doing it in less than 6 months. Does the growth situation warrant so much generosity?
Well, I'm not going to second guess the Reserve Bank of India's thinking on this, but I think it wouldn't hurt at this point in time. This is, again, I think in the nature of a preemptive move to try to neutralize whatever is expected will be the outflows from the system through cash extractions, through the ongoing Rabi procurement season, etc., which is typically this is the time when there is an upsurge in liquidity outflows from the system. And then there are the expected, I don't know that. I mean, the presumption is that there are some, in the FX space, there might be some need for liquidity. So I presume this is a preemptive series of measures to put in. And I don't think, given the forecasted path of liquidity and path of inflation, I'm sorry. So given that, I don't think there is anything wrong in this. I think this is a measured step that the RBI is taking.
Okay. Well, I hope it is a measured step. I just remember that between 2010 and 2013, was it, the Subir-Subbarao combo had put in liquidity, and we also harvested double-digit inflation. So anyway, those were different times, very different times. But Saugata, just to come back to the real rate that the Reserve Bank calculated, 1.4 to 1.9, what therefore may be the end rate of this cycle? Should it be closer to 1.9, in which case you stop at 5.5 or something? Or should the end, should you take 1.4 as the real rate, in which case the repo rate cut can go all the way to 5.25? Where would you lean?
Given the current growth inflation balance of risks in the system, that if inflation and the drivers of inflation actually keep inflation towards 4% or maybe even lower, if that actually happens. And this is exactly the reason that why I'm arguing for a measured series of cuts rather than front-loading cuts in the right at the beginning. That if this growth inflation balance happens to be more tilted towards slower growth, then I think I would lean towards the lower end of the band. So 1.4, 1.5 or thereabouts. Because I think, as you would probably agree, itself will be the heavy lifter of supporting growth. And this would probably require a combination of measures: monetary, fiscal, trade, commerce, labor, etc. A whole series of policies that would be needed. But I definitely think that there is probably a need for monetary policy to support growth.
Okay. Well, thank you very much, Saugata. It's been a pleasure listening to you. Thank you very much for parsing the options before the Monetary Policy Committee. And we do hope that you will join us in subsequent meetings as well.
My pleasure.
Thank you. Well, an important point from the Saugata Bhattacharya interview is that the Reserve Bank is not, mandated to put the stance to vote. It is only the rate decision that is put to vote. The stance was voluntarily put to vote only under the Shaktikanta Das regime, not before when Urjit Patel was chairman, was governor, and not now that Malhotra has taken over. I think that's a very important change that we need to take on board as watchers of the market. Wrap up on Bazaar on that note. Chartbusters coming up.